Welcome to today's deep dive. We have a very clear mission for you today.
Yeah, we are unpacking the weekly crypto outlook from Vantage Plus.
Right, exactly. Specifically, their Monday analysis published on March 5th, 2026. So picture a booming party, the music is blasting, everyone is dancing.
That is basically the U.S. stock market right now.
Exactly. It is just climbing from one record high to another, but then you have that one friend like sulking in the corner, just completely refusing to join in.
The ultimate wallflower. And right now, well, that is the cryptocurrency market.
It's such a glaring divergence, you know? Traditional markets are soaring, risk sentiment is incredibly strong, but crypto is just, well, it's lagging behind. Okay, let's unpack this.
Sure. So to understand the why, we really have to look at where institutional money is moving.
Huh.
I mean, rather than just staring at price tickers.
Right, you have to follow the actual money.
Exactly. The ETF data from Vantage Plus paints a pretty stark picture of capital rotation. Like in late May, Bitcoin and Ethereum saw a combined $2 billion completely vanish from their ETFs.
Wait, 2 billion? That is just massive capital flight.
It really is a huge number.
So if the broader stock market is booming, why are institutions suddenly pulling their chips off the crypto table? I mean, if the stock market faces profit-taking, won't that just drag crypto down even further?
Well, what's fascinating here is it really comes down to momentum exhaustion. When an asset tries repeatedly to break a ceiling and fails, the big money just gets impatient.
Yeah, they don't want to just sit around waiting.
Right, institutional capital doesn't like to sit idle. It rotates to where the momentum actually is, like, those record-breaking equities.
But the Vantage Plus report claims that long-term crypto investors are supposedly celebrating these drops. Like they see it as a clearance sale or something.
Yeah, they do see it that way.
Honestly, you were telling me people are cheering a $2 billion exodus. That sounds like pure copium from traders trapped in bad positions. Where is the proof this is actual accumulation and not just a mass exit?
Well, that is the million-dollar question. And it's exactly why the charts are so tense right now. Long-term buyers aren't just blindly hoping. They are waiting at very specific structural floors.
Okay, so let's look at those floors. Take Bitcoin, for example.
Right, so Bitcoin is currently at $73,703. It recently tried to smash through an $82,000 ceiling, and it failed completely.
Yeah, and it formed what technical analysts call a bearish pin bar.
Precisely. Conceptually, that pin bar pattern just means buyers ran out of steam.
It's like a visual rejection on the chart.
Exactly. Now Bitcoin is sliding, and everyone is watching to see if it drops down to its 50 moving average.
Let's pause on that jargon for a second. We hear 50 moving average constantly in these reports. But why does that specific invisible line matter so much to these institutions?
Think of the 50 moving average as, well, the market's collective memory over the last 50 periods. It represents the psychological baseline of the current trend.
So as long as it's above it, things are good.
Pretty much. The consensus is still bullish. But if it breaks below that line, the narrative shifts entirely. It triggers automated sell-offs.
Wow. And that average for Bitcoin is sitting way down around the $59,000 zone, right?
Yeah, which is a big drop.
So if it breaks below 72,000, it could plunge all the way down there. It's basically a tripwire for market psychology. Which brings us to Ethereum.
Yeah, Ethereum is sitting at $2,018 right now. And the report notes it's resting directly on a multi-year rising trend line.
So I have to ask, is this multi-year trend line an unbreakable concrete floor or like a fraying safety net?
Well, it is facing heavy resistance at its own 50 moving average of $2,419. So it's acting more like a pressure cooker right now.
Right, squeezed between historical support and heavy resistance.
Exactly. If it can't break upward, that multi-year floor is going to get tested violently.
Here's where it gets really interesting, though. While $2 billion was fleeing the heavyweights, the data shows a weird anomaly with XRP.
Yeah, XRP ETFs actually saw an influx of about $35 million in late May.
35 million. That is a fascinating structural shift.
It really is. You have capital fleeing the market leaders, but rotating into specific legacy altcoins. XRP is at $1.35, sitting right on a critical psychological barrier.
Right, it needs to drop below $1.30 to stay in a downtrend. But if it breaks above $1.50, that could open the door to $2.
Exactly. And then you have Solana at $82.70, battling persistent bearish sentiment.
Yeah, slipping below $80 spells trouble for Solana, but a June rally above 100 signals a breakout.
Right. It's less about the exact pennies and more about these huge psychological zones. So if we connect this to the bigger picture for you as the listener, it comes down to your personal timeline.
Are you a short-term trader sweating over these resistance lines?
Or are you a long-term buyer enjoying the discount, waiting near those moving averages to accumulate?
Which circles us right back to our original mystery, the booming stock market party.
Yeah, the big divergence.
Right. If those long-term crypto investors are cheerfully buying the current dip while traditional stocks are flying high, you have to wonder, what happens if that U.S. stock market suddenly cools off?
That is a very scary thought.
Right. If the broader party ends, does buying the crypto dip suddenly turn into catching a falling knife? Something for you to mull over this week. Thanks for joining the deep dive.